So good morning, everyone. Delighted to welcome you to part 2 of the Burness Poll Third Sector Conference 2021, which continues as part of a series of 5 online sessions every morning this week. The last week of full-time homeschooling, fingers crossed. The theme of this year is resilience. How can third sector organisations future-proof their organisations to protect against the uncertainty of the future? This morning, I invite you to have a virtual cheer coffee with my colleague Rona McAdam, who will be discussing trading by third sector organisations and the use of trading subsidiaries as a vehicle for growing future income generating activities. And without further ado, I'll pass you over to Rona.
Thanks, Graham. So morning, everybody. Lovely to see you, sort of. I can see a few people, so hi. So yeah, as Graham said, I'm going to talk through trading subsidiaries and use of trading activity to grow your commercial income. Graham also mentioned that the theme of our conference this year is all to do with resilience. So when I was planning for the conference, I kind of asked myself, well, what do we mean by resilience? Now, anybody, I know there's a couple of people logged in this morning that were also at Gillian's session yesterday morning. So anybody that was participating in that would know that actually resilience can apparently mean a lot of things. There's a resilience alphabet apparently. So for her child who's very early primary school, he's learning a lot of different things about what resilience can mean. But there's one definition that stood out to me when I was looking at this, and it's the capacity to recover quickly from difficulties. And I think that's very relevant just now in the current environment. As we're hopefully starting to emerge from lockdown, although it might not seem it, hopefully there'll be some good announcements about easing of restrictions from Nicola later this afternoon. And by Nicola, I mean Nicola Sturgeon. I've realised actually in the last year that I started referring to Nicola by her first name, like she might be one of my best friends. But you're just so used to listening to her every day now and speaking with your family and your friends about what she's got to say. So yeah, so hopefully there'll be some a little bit of good news later on today. So it's almost been a year actually to the day that we were put into lockdown. We were all sent home from our offices, and I've not really moved from this table in my kitchen since then. So yeah, I think it's really relevant as we're kind of now hopefully looking forward to the future to start thinking about how things will start to recover and how we can kind of get past a lot of the difficulties that we have experienced over the last year. So a lot of businesses have been looking at different ways to recover throughout the course of the pandemic and also looking forward. So they've been looking at different efficiencies and the way that they operate, different things that they can offer to their customers or their clients. One of my personal favourites has been the cocktail deliveries to your door. I think that's great. But in the third sector's no exception to this. Not that I'm saying that the third sector should be offering cocktails to people's door, but you know what I mean. A lot of third sector organisations are looking for ways that they can start to recover and move forward. There's been concerns throughout the pandemic, and I'm sure there will be for sort of years, months to come about the impact on funding and the availability of funding. And one way that we've seen clients looking to look at sort of a different way to raise income rather than just the traditional funding routes is to grow their own income through trading. So let me just share, and hopefully this will work. If anybody can't see this, then these slides, then just drop a wee note in the chat function. As Graham said actually at the start as well, if you've got any questions throughout, drop a wee a wee note in the chat function. It can either be sent to everybody, or if you want to keep it more anonymous, you can send it directly to Gillian, and Gillian will be able to kind of anonymise it and ask that question. So what are we going to cover today? So first of all, what is trading? Common misconceptions around trading. When a charity can trade, when a trading subsidiary should be used, the advantages and disadvantages of using a trading subsidiary, what that trading subsidiary might look like, and just some points to consider. So we are, as you've probably been able to tell from that first slide, going to kind of focus on charities. Obviously, there's third sector covers a lot of different organisations, some that are set up as community interest companies, etc. But they'll have less restrictions on their trading activity than what a charity would. So the main focus is going to be, particularly for the first half of this presentation, about restrictions covering charity trading. So what is trading, first of all? It's not as simple as you might think. Might seem like a silly question to ask, but one of the essential components is that it involves the sale of goods and services. But however, although you may sell goods and services, it might not actually be regarded as trading. So there's some factors that are taken into consideration when you're looking at whether a certain activity is trading activity. One of those is profit motive. If there's an aim to make money, even if it in the end turns out the activity doesn't make money or as much money as you might have thought, if there is that initial aim to make money through the activity, then it's more likely to be considered trade. Repetition, if it's an activity of an ongoing nature, again, more likely to represent trade. Enhancement, now if you've bought something with the intention to improve it and then sell on for a profit, more likely to, again, to suggest that you are trading. If, for example, ever it's bought for the charity to actually use, and years down the line it's then sold on, then kind of more likely not to be considered trading. The mechanism for selling, so if you've set up a physical shop or you've set up an online shop, more likely right now, then those kind of ways of selling are more likely to be considered to indicate trade. And the time between the purchase and the sale, so if there's a quick turnaround between what you've purchased and then what you've gone on to sell, then more likely to be trading. Now, why is it important whether it's considered trading or not? So one of the things is you need to consider whether, as a charity, it would be allowable for your charity to carry out the type of trading activity. But also from a tax perspective, the profits could be subject to corporation tax unless it's an exempt type of activity. So just before we go on to what the exempt activities, trading activities are, just wanted to pick up on a couple of common misconceptions about charity trading. So the first one is that a charity can't trade and can't carry out any trading activities. As you've probably gathered from what I've said so far, that's not correct, but it is something that a lot of people still to this day seem to think is the case. And the other thing that we hear a lot of is, well, I'm going to carry out this trading activity, but the profits that I make from it are going to be reinvested straight back into the charity for the furtherance of our charitable purposes. So surely then that's okay. Well, no, that's not the case. It's not about what you do with the profits, although that is important. It's about the actual trading activity itself. So when can a charity trade? So the first category is what we call primary purpose trading. And it's actually important to know, actually, from just a kind of starting point, that in any of these situations of when a charity can trade, it must be allowed for in your constitution. So more likely you would want to review your constitution just to make sure that there's not any specific exclusions that would prevent you from carrying out the activity. So primary purpose trading is where the trading activity directly contributes to the furtherance of the organisation's charitable purposes. So the activity can both make money, but it's also part of the charitable work that your charity can carry out as part of its purposes. And the profits from the trading activity must be applied solely in furtherance of your charitable purposes. So a couple of examples of primary purpose trading would be the provision of educational services by a college in return for course fees, the holding of an exhibition by a charitable museum in return for ticket admission. So the money that you get from tickets that you sell to the general public would be considered primary purpose trading because it is to access the museum, which would be in furtherance of arts, heritage, culture, etc. And then another example would be a healthcare charity providing therapies and treatments in return for a fee. Now the next kind of, I say category, but it's more of sort of a subcategory of primary purpose trading, but just to pull it out separately, of when an example of when a charity can trade is when the work that's carried out in connection with that trading activity is mainly carried on by the beneficiaries of the charity. So an example would be a restaurant in a college that's operated by students as who are attending the college as part of a catering course. So an example would be, I remember quite a few years ago, Motherwell College, although that now New College Lanarkshire, I think they're called. But at the time, Motherwell College operated quite a successful restaurant that quite a lot of people, it got a lot of positive comments, and it was run by its students. Or the operation of a cafe by a charity that is set up to help people with learning difficulties and is mainly staffed by individuals who have learning difficulties and use the charity's services. It's important to note that not all of the workers need to be beneficiaries of the charity. So you could have a situation where you would have other people involved, but you would want the kind of greater part of your staff to be beneficiaries of the charity. So another example of when a charity can carry out trading activity is what's known as ancillary trading. So this is trading that doesn't directly advance your charity's charitable purposes, but it contributes to the success of the furtherance of those charitable purposes. I've heard it described as sort of activity that's a byproduct of the main activities of the charity. It's basically just activity that's exercised in the course of carrying out your charitable purposes. It's kind of part and parcel of it. So examples would be the sale of food and drink in a cafe within a museum to visitors to the museum exhibition. You would expect the operation of a cafe to most likely form part of the services that would be available in the operation of a museum, but obviously the sale of food and drink doesn't in any way further sort of the advancement of arts, heritage, culture, etc. But any sort of profits from that would be in ancillary trading and would therefore be exempt for tax purposes. Worth noting, however, that sale to the general public, so people who are just walking in off the street and who aren't actually attending the museum's exhibition, for example, would not be considered ancillary and therefore would be non-primary purpose trading, which we'll come on to speak about. And again, another example is sale of stationery or books by a college to its students. So again, not necessarily directly furthering the charitable purposes of the college, but sort of part and parcel of the college offering. So another example of when a charity can carry out trading activity is where you have non-primary purpose trading that's not doesn't involve a significant risk to the resources of the charity. So it would be activity that's intended to raise funds as distinct from trading which in and of itself furthers charitable purposes. So for example, the operation of a charity shop which sells donated goods and clothes, etc. That's set up sort of for the main intention of raising funds, or the sale of Christmas cards is another example that's quite commonly used. Again, usually, most likely, it's an activity that's carried out simply for raising funds. So a charity can only carry out that type of trading activity, as I've said, if it's not posing a significant risk to the resources of the charity. Now, whether it's considered to be a significant risk depends on the charity itself. So you would need to look at your kind of own circumstances when you're considering whether it would be possible to do. There's no sort of set rules around what significant risk to a range of charities would be. But in general, and the very basic kind of perspective to look at it is that the turnover from the activity should be sufficient to meet the costs of carrying out the activity, so that if there was so that there would be sort of no shortfall that would then mean that you would have to kind of look to the charity's assets to make up any shortfall. Common examples in kind of this area that are used is the kind of operation of lotteries. So there's rules around that. Charity must have a license, etc., to be able to do that. But as you'll probably appreciate, there's most likely not a significant risk to the charity's resources in carrying out a lottery. You're selling a number of tickets, and you'll have a set prize, and that's the operation of a lottery is most likely the primary kind of aim of that is to raise funds. And another example of non-primary purpose trading that's not doesn't involve significant risk to the charity's resources is exempt fundraising events. Now there's a whole host of rules around how many fundraising events, etc., can be carried out by the charity. We've only got half an hour, so I won't go into all of that, but just be aware that that's something that you'd probably want to look up as the rules around fundraising events if that's something that you're looking to do. In addition, it's also not generally thought to be significant risk to a charity's resources if the income from the activity is below the small trading exemption. So the small trading exemption depends on a charity's gross annual income. So if the charity's gross annual income is £32,000 or below, the charity can generate income from non-primary purpose trading up to a limit of £8,000. And that would be allowable, and the profits from that would be exempt from tax. If it's between 32,000 and 320,000, the allowable limit is 25% of the total annual turnover. And if it's over 320,000, if the charity's annual income is over 320,000, the applicable limit for profit from non-primary purpose trading is £80,000. So the total turnover from all of your non-primary purpose trading cannot exceed those limits, depending on where your charity would fall based on your income. If it does, the charity, the profits from that may still be exempt if the charity had a reasonable expectation that the profits from the activity weren't going to exceed the relevant limits, and you would need to be able to provide evidence of that being the case. If the profits from the non-primary purpose trading do exceed the limits and there's no reasonable, you can't demonstrate reasonable expectation, you would be taxed on all of the profits from your non-primary purpose trading. Important to note that you may still have primary purpose trading, and that's absolutely fine, but all of your profits from non-primary purpose trading would be subject to tax. It wouldn't be sort of, if your relevant threshold's 8,000, it wouldn't be over profits over the 8,000, it would just be all of the profits. Just a small point to note about mixed trades. If you have an activity that's partly primary purpose trading and partly not, it's regarded as two separate trades, and therefore you have to account for both separately. The non-primary purpose trading element would be taxable unless it's within the small trading exemption, and you would have to ensure that you've got appropriate accounting systems in place, which means that you would be able to apportion your receipts and expenses on a reasonable basis. So examples are a shop and an art gallery. It might sell prints of paintings or from an exhibition it's got on. That would be considered primary purpose trading. However, the shop may also sell promotional pens, mugs, coasters, key rings, all that type of thing. That would be non-primary purpose trading, and that would be, the income from that would be taxable unless it falls within the small trading exemption. Another example is serviced accommodation lets for students in term time, which would be regarded as primary purpose trading. And then if in kind of non-term time, so through summer, for example, the same accommodation was let out to businesses for business purposes, or tourists, for example, then that would be non-primary purpose trading, and would be subject to tax. So when should a trading subsidiary be used? So where you have non-primary purpose trading, which poses a significant risk and or is above the small trading exemption, where you have no power to trade in your charity's constitution, or where a tax liability is likely to be incurred. The advantages and disadvantages, I'll try and run through this quickly. I didn't realise how close we were to the half hour. So try and run through the rest of this relatively quickly. Advantages of using a trading subsidiary. It doesn't prejudice the charitable status of the main organisation. So you're not concerned about having to make sure that all of the trading activity that you're carrying out is certainly going to be considered to be in furtherance of your charitable purposes. It protects the charity's assets from risk. So if there was anything sort of bad to happen in the operation of these trading activities, it's sort of separate from the charity's own assets. So there's less of a risk that the charitable assets would be used to make up any shortfall that we've discussed. It reduces tax liability. So in the case of a charity with a trading subsidiary, it would usually be the case that the trading company donates its surplus profits up to the parent charity through the gift aid scheme. And that would mean that there would be no corporation tax due. Whereas if the trading activity was run through the charity, then for all the reasons we've discussed, if it's above the small trading exemption, all that kind of thing, then there's the potential that you would have to pay tax on the profits. So the charity wouldn't pay tax provided that the profits are used in furtherance of its charitable purposes. And also just important to note that any gift aiding up of the profits would need to be made within 9 months of the trading subsidiary's financial year end. Another advantage is that it provides for clarity and separation of activities, so the charity can focus on furthering their charitable purposes, and the board of the trading subsidiary, which we'll come on to, can focus on making money, which will then be gift aided up to the charity. Disadvantages: cost of setup. So if you're setting up a company, there'll be costs involved, and just the incorporation fee, for example, that you have to pay to Companies House. There will be things to think about, like your drafting of your articles. If you want to kind of have some bespoke articles, you may want to get a lawyer involved, and that will obviously ramp up costs. There's an additional administration element to consider. So on an ongoing basis, if you've got a company, then you would have to file accounts and annual returns, etc., with Companies House on an annual basis. Then there's also the preparation of the accounts. Another thing that can be a disadvantage is that if the subsidiary uses part of the charity's property to carry out its activities, so for example, if you've got the charity operates out of a building and part of the building is used by the subsidiary, then the rates relief in respect of that part that is used by the subsidiary might actually be lost. And conflicts of interest can be difficult to manage sometimes, so I'll come on to that and not cover that separately. So what might that trading subsidiary look like? So most cases it's a company limited by shares, not typically a charity, because it's specifically set up to raise funds. The charity would be the sole shareholder. So in the cases where we're just setting up a kind of normal trading subsidiary, nothing particularly exciting or different about it, we would usually have sort of 10 shares or 100 shares of £1 each, all of which would be owned by the charity. The charity would usually be given the right to appoint and remove the majority, or appoint and remove the whole board of the subsidiary. And one thing we would usually suggest considering from an oversight purpose is having some of the charity trustees sit on the board of the trading subsidiary, but not all, because you probably, if you're doing different things from what the charity are going to be doing, you probably want to get other individuals involved that have other relevant experience. And the other thing to consider, as I said in the disadvantages point, is conflicts of interest. As you'll appreciate, if you've got same individuals sitting on the board of a charity and then the board of the trading subsidiary, there can be points where conflicts of interest considerations would come into play, and you would need to consider how those are managed and make sure that you would still have enough non-conflicted directors to be able to make decisions for the subsidiary. And the board of the subsidiary, it's worth noting, has primary responsibility for exercising overall control and supervision in relation to activities. So even though it's a wholly owned subsidiary of a charity, the board of the subsidiary itself has the main responsibility for how the subsidiary is operating. So some points to consider if you're setting up a trading subsidiary. First thing would be the name of the trading subsidiary. So you can't have a name that is the same as the parent organisation. So for example, the parent organisation might be called Bumblebee's Nursery, and I've just made that up off the top of my head. I don't know if that's something that exists, but it might. You might want to have for the trading subsidiary the name Bumblebee's Trading, for example. Another thing to consider is shared resources. So the charity can't subsidise the trading subsidiary by providing free staff time, for example, or free kind of access to the charity's premises for use. So we would usually suggest putting in an agreement into place where a fair rate is charged for any staff that's used by the trading subsidiary, any of the charity staff that's used by it. And in terms of the use of the charity's premises, we would always suggest that a lease is put in place, that there's rent payable by the trading subsidiary, and that should be on an open market rent. You can't just say, well, it's a trading subsidiary, so we're going to give it a kind of vastly reduced rent. As you'll appreciate, anything a charity does has to be in the best interest of the charity. So therefore, when considering whether to allow the trading subsidiary use of staff or space, you have to kind of consider that at an arm's length and how you would with any other kind of decision that you're taking in relation to another organisation. Conflicts of interest we've already touched upon, so I won't go over it again. Funding for the trading subsidiary is obviously quite an important initial point to consider, and it's usually the charity can fund the trading subsidiary by way of share capital, or more likely the providing a loan to the trading subsidiary. As I've said, everything that a charity does needs to be in the best interest of the charity, so it needs to be justified as being an appropriate investment of the charity's resources. If by shares, by kind of investing by way of share capital, you're maybe unlikely to kind of raise the funds that you would need for startup costs and capital. So what we tend to see more is the provision of a loan, and that does give greater reassurance of repayment as well to the charity, because there's a contractual arrangement that will be in place. So we would suggest or highly recommend putting in a formal loan agreement, which should be entered into on a commercial basis. There should be appropriate repayment terms, and interest should be payable as you would expect with any other loan that's made, and that should be at a market level as well. And when the charity is making that decision to make a loan to its trading subsidiary, then that should be well documented in the minutes, and clear that the trustees are happy that it's been made in the best interest of the charity. Final point to consider is just if the trading subsidiary were to run into financial difficulties, then again, the charity always has to be thinking about the best interests of the charity. So actually the best interest, if the trading subsidiary is losing money and it's actually becoming a burden, then it could be that they would need to consider winding it up. So conscious that I am just over time, but some of you might be thinking, and I'll just try and cover this off quickly, what about Newlanark? So I have, well, some of you might be thinking, my goodness, can you please be quiet now because you've well run over your time? But a few of you might be thinking about Newlanark. So for those that aren't familiar with the Newlanark case, it was a recent case. I would highly recommend that you have a read over a spectacular blog that was written by myself and my colleague Gillian. And this was all to do with the Newlanark World Heritage Site. The it's kind of overall operated by Newlanark Trust, which is a charity, and it had trading subsidiaries, Newlanark Hotels Limited, I think it was called, and Newlanark Trading, I think they were called. And the hotel subsidiary, as you would guess, was responsible for operating the hotel, spa facilities, all that type of thing, and the trading are the New York trading subsidiary, Newlanark trading subsidiary. I'm wishful thinking here that I can go back to New York sometime soon. Newlanark trading subsidiary would carried out other trading activities, so like the gift shop. So given everything that I've just said about what's primary purpose trading, etc., you might expect traditionally those types of activities to be considered as non-primary purpose trading, and that's why they were routed through trading subsidiaries. However, they did apply to Oscar for charitable status for those trading subsidiaries, and that was refused. So exciting time for us lawyers at the start of the year, because not much else has been going on in lockdown, was the this is kind of run through the last couple of years, has gone through a court process. It ended up in a court of session in our house at the start of the year, and a decision was issued. Now, a lot of people would think that the decision might suggest that, well, actually the operation of a hotel, etc., or a gift shop actually could be primary purpose trading. So why would we want to now talk about trading subsidiaries, etc., because it could be routed through the charity? However, when you kind of read more into the case, I wouldn't say that it changes anything. And in most cases, you would probably still want to consider routing these types of activities through a trading subsidiary. The specific example of Newlanark was the judgment was very focused on the Newlanark setup, in that it's a functioning sort of economic village, and some of these activities were inherent in the running of a kind of village. So the circumstances are very particular. So I wouldn't really say it's as groundbreaking as what we maybe would have thought when you first kind of picked up on the I say headlines like it's some sort of juicy, but it was for charity lawyers. Yeah, I've probably not done it justice there when I was speaking about it, because I'm so conscious of the time that I've overrun. So yeah, they probably could have spoken about that for a lot more. But as I said, the reason that I hadn't kind of touched on it is actually because it probably isn't as significant as you might have first thought when looking at it. But yeah, if anybody has any further questions about that specific case, then we can certainly look at that separately. But that was a very, very quick canter through, and probably not, as I said, doing justice to the case and the meaning. So that then brings me to an end. Just opening up to questions. I appreciate that some people had to log off already. Apologies for the overrun, but if there's any questions, then please just shout out or put in the chat function. And as well, if there's any questions that you want to pick up with us separately, then we can certainly do so.
There's a question about gift aid in terms of transfer of profits, and this is just the point about how a trading subsidiary can theoretically transfer 100% of its surpluses as a gift aid mechanism up to the parent company. So an accountant would actually be able to help you more with that one, and actually the reality is that 100% of the surpluses tend not to be gifted up. You might retain some for cash flow purposes. But that was the only question. Just can you explain more about how gift aid works for transfer of profits?
Yeah, an accountant, as Gillian said, would probably be best to kind of advise on the specifics of how that actually works. I, in a former life, used to be an accountant, as our former partner used to love to tell everybody. But yeah, I'd like to kind of leave that side of
And
things
you've got,
in the past.
just say, you've got a certain period of time normally within which you can make that payment within X number of months after
Yeah,
the financial year end. But what's more
it's
common
9
now is
months.
to have a deed of covenant, you know, a contractual obligation on a subsidiary to make payment to the charity, which is, that used to be the approach that was taken, and that's kind of come back now for various accounting reasons.
Thanks. Any other questions? No, well, there's nothing in the chat function to everybody.
Sorry, one more. Are VAT status and corporation tax liability entirely unrelated? Sort of. If you have a wee look at the HMRC Charities website, there are certain VAT exemptions apply to charities, but yeah, it is a different point. Basically, any charity that registers with HMRC Charity, any company, will be eligible for corporation tax relief entirely, but VAT exemptions are a wee bit different. So have a look at the HMRC Charities website. I actually emailed someone else, sent an email privately to me during this and asked for information on this. So whoever, Etienne, if you send me your email address privately, I can send you links to that.
Perfect. Thanks, Gillian. And well, if that's all the questions, then I think we can wrap it up there. As I said, though, if anybody's got any specific questions that they want to pick up with us separately following this, then yeah, Colin, definitely. We'll pick up with you on that, and we can get that one moving. So yeah, if anybody's got specific questions, then please just feel free to pick up with us separately. You'll find our information, if you don't have it already, on the firm's website. Somebody just asked about slides being shared. Yes, they will be shared, and this has also been recorded as well, so that recording will also be available through our website. So yeah, many thanks for joining, everybody. Hope to see some of you throughout the rest of the week. Thanks.